we are condition red. I mean it. We are condition red. The next time that we have a run on physical silver, and it could be a 3-day run like we saw in late January, February, 110 million ounces. The next 110 million ounce run, we're very low at that point with not a lot of production coming. That's when you're going to see silver pop. You'll see gold pop too.
This week's special with Miles Franklin Precious Metal Investments. 2022 Silver Krugerrands for only $409 over spot. To order, call us at 1-888-81-LIBERTY. That's 1-888-815-4237. Hey everyone, this is Elijah K. Johnson with Liberty and Finance. And back with us today is our good friend Robert Kientz from Gold Silver Pros. Robert, thank you so much for joining us today.
Thanks for having me on, Elijah.
Now, last time we had you on, we were talking about how a lot of the top CEOs were selling a lot of stock. And this was very interesting how, the stock market is at all-time highs and now top CEOs are getting out of a lot of their positions. Now, since then, we've just seen the stock market continue to rise. It's now hitting all-time highs as we record this on Thursday, December 30th. So your perspective on what is happening right now in the stock market?
I think last time we talked, CNBC had it as 69 billion of stock, insider stock sold this year, insider and large directors and things like that of corporations. I think it's going to continue. We estimate maybe 70 to 80 billion for the year. The numbers aren't in quite yet. We'll see the numbers come in probably here in a few days and some totals, but it's, the highest it's ever been. And that's caused by two things. It is caused, as you pointed out, by high valuations in the stock market and people exercising their options. I think Musk is selling he wants to sell another billion of stock as well. So people are taking advantage of the fact that we have these all-time highs in the stock market. Last time we talked about how we know they're all-time highs. We look at a metric called PE10 or this CAPE, which is a cyclically adjusted PE ratio. It's a rolling 10-year average of price to earnings ratios on stocks, meaning price to earnings, meaning how much you're paying for what they're able to produce as income, and it's really, really high. So stocks are, historically speaking, extremely overvalued. And one thing that a lot of people may not understand is that while there are a lot of stocks making money right now, what's happened is the BIS put out a report not too long ago that was looking at zombie companies, and zombie companies are ones that don't produce a lot of profit, can't pay off their debt, and basically are kind of dead man walking. And it's the highest it's ever been since the BIS has been keeping track of that. And the confidence index for how many companies could recover from that situation without going out of business is at a low, meaning a higher percentage of zombie companies now versus, say, 10 or 12 years ago in the financial crisis are more likely to go bankrupt or have to be bailed out or have to be absorbed or broken apart and absorbed by other companies. So we know right now that the stock market's going to correct. It always does when we have these very high PE ratios. And I think the insiders know that. I think they're continuing to sell their stock. And I think they're doing it before these zombie companies finally, have to give it up. And we're talking about zombie companies around the world, not just the U.S. stock market. So there are more zombie companies in the world than there have ever been, ones that can't actually continue operations profitably. I think all of this comes to a head, essentially, when we start to have more of a debt crisis. And I think we'll have a debt crisis when interest rates rise. The Fed wants to raise interest rates in 2022 from 0.08 to 0.9, I believe, 0.9%. That in itself probably won't be enough to collapse the debt markets, but it will put some pressure on the debt market. The other thing we'll have to look at is inflation. If inflation continues to rage, it will put upward pressure on interest rates, and it'll make things much, much, much more expensive. It'll put pressure on the housing market, things like that. So we're going to have to track that in 2022. I don't know whether insider sales are predicting a bond market issue and a corporate bond market issue in 2022. We'll have to look at that, but it certainly seems to me that the insiders and executives of these companies know they're probably not going to get a better price for their stock going forward, even though we're hitting all-time highs. And they're selling probably a little bit before the top, but they're selling out, much like I sold my real estate a couple of years because I believe we're in a real estate bubble. And I think they're selling a bit early, and I think that's an indicator that they know that they're overvalued. And of course, we know, the PE ratios are historically overvalued as well. That tells us.
No, this is all happening amid the Fed double tapering. From a few weeks ago, we got that announcement. So your perspective on that, what the Fed will actually do this coming year as we're entering the new year, and also where the stock market is heading, because I think that's an interesting dynamic. If we do actually see a stock market crash, that might put pressure on the Fed to ease.
If you look at the numbers of the Fed and what they're actually buying that they publish, they haven't really tapered yet. It'll be interesting to see. They announced tapering and basically stopping all of their purchases by the end of March, so the end of Q1 2022. They've said that they're starting to taper now, but their purchases are still where they were before when you look at the numbers. So they haven't actually started a strong tapering program or started reducing. Tapering means reducing the amount of asset purchases, right? They haven't done it yet. They said they're going to do it by, I think, was it 10 billion in mortgage-backed securities and 20 billion in other securities that they're buying starting January and then February, March. We'll have to see what happens. If they do, Elijah, what that does is it takes away one of the biggest buyers of this debt in the system, and that means somebody else has to go buy it. Well, if there isn't demand for this debt, that puts pressure on that debt, and that could potentially start a cascade. Because if you have people not buying debt, what do you have to do? You have to lure them in. What do you have to lure them in with? Higher interest rates. Well, that puts pressure on the existing debt that's out there because it devalues it. Because interest rates and bond prices are inversely correlated. As interest rates go up, to make new debt issuance more attractive, the prices of existing debt at lower interest has to come down, or else people won't buy it. So we'll see how the Fed decision actually affects the market, but it could be really dangerous. I mean, the not buying those assets could have a higher short-term effect or a bigger short-term effect than the raise in interest rates, because I don't think the raise in interest rates is super aggressive. To 0.9% by the end of 2022 is not going to collapse the market and cause major issues. It will put pressure on it. But I think the reduction in purchases probably will have a bigger short-term effect. We're really going to have to see if the Fed can actually do it. All the people that I talk to think it's nuts, and there's no way the Fed will actually be able to completely get rid of their asset purchasing program by the end of Q1 22, because we've had it now for 12 years, but we'll see what happens. I mean, that's going to be, I think, the big story of Q1 in terms of a macroeconomic perspective. Does the Fed actually end its asset purchasing program? We're going to watch those numbers.
Now, another market that's been feeling some pressure, as you've been reporting on, is the housing market. I know we touched on this last time, but what are some updates you have on that?
So the housing market is starting to decelerate. So year over year in October, across the U.S., housing prices went up 19.1%. People say, wow, that's great. I earned 19.1%, on my home year over year, October to October, last year to this year. But it's decelerating, and it's the third straight month in which we've come down. The previous month, it was 19.7, then it was in the 20s. So home prices are still rising, but the rate at which they're rising is decelerating, and now we have a trend. We have 3 months of data. Then if you look at new and existing home sale data, it's below what analysts expected. It's still positive, but it's decelerating also. So what we're starting to see is some pressure in the housing market. Now, I reported a couple months ago on our channel that inventories were starting to creep up just a little bit. Now, it depends on where you are. We're talking overall for the U.S. And in my area, we don't have enough inventory in North Texas because the immigration from all around the world, other states and around the world, is so strong. And we're such a pro-business state, companies moving here, that I think we're going to continue to have high real estate prices. But net across the U.S., there's more inventory. And so prices will have to fall there. We're going to have downward pressure on prices as inventory starts to creep up. And we're starting to see that in the housing market. Now, I'm calling it very early because we tend to be ahead of the game at Gold Silver Pros, and we look at trends. And when we spot a trend, even though it's still positive, but it decelerates, we want to point it out, because you may only have a few months to plan if you plan on either buying a home or selling your home or refinancing your home. And homes, Elijah, the equity in homes is one of the largest stores of wealth for Americans. And so that's something that we need to look at. How is this going to affect the average American's wealth in 2022? It's going to be a big story. It's a big story in 2021 for the Chinese housing market. Remember Evergrande and Cynic and all those companies that defaulted, got downgraded, and the Chinese store even more of their wealth in homes as a percentage than do the Americans. So the bigger picture here is we're starting to see pressure on the housing market across the world in the two major economies. Will this happen in Europe? Will it happen in Russia? we'll have to track that. But it looks like we're starting to see those economic pressures affect the housing market. So we want to report on that as soon as we see it.
So essentially what I'm hearing is the rate of increase in prices is slowing, right? And that's kind of the first indication. It could still go up from here, but it's showing that in the near future, it looks like there could be a downturn.
Yes, and I do believe what the central bank does, what the Fed does, along with the ECB, along with all the other world central banks, take the G7, the G20, if you will, their policies in 2022 are going to drive the debt markets, and they're also going to affect the housing market. So pay attention to what these central banks do, especially the Fed, being that the dollar is a world reserve currency. Pay attention to what they do. It's going to affect whether we have another melt up, whether we have severe deflationary pressures. If we go by what the Fed, if we take what the Fed said, lock, stock, and barrel, and believe in it, and they taper and raise interest rates, it's going to cause a deceleration in gross domestic product of a lot of these nations. It's going to cause downward pressure on the valuation of the stock market, on the housing market, in bonds. It's going to have major effects because the central bank produces the money, right? So the money is what affects all this. How much money do you have sloshing around? How do people react to that? How much inflation? Where are the interest rates? So we got to watch the central bank first. So we see a decelerating housing economy because it got overheated, right? That the houses are worth more than they've ever been, comparatively speaking, over time, not only stock market, but the housing market. So as the central bank goes, these other asset classes go. We're going to have to watch it. But I do think what we see in the first couple of months of 2022 is going to tell us where we're going in bonds, stocks, and in housing.
Now, I've heard that January is normally very strong for both gold and silver. Your perspective on what we might see this coming month and for the rest of 2022?
So gold and silver are doing okay. They're up just a wee bit today. I think gold, as we're recording this, is up $4 and silver's up 18 cents. It's nice. Gold is sitting above 1,800. That's a nice level. 1,800 is a nice support level. $23 in silver is a bit low, to be honest with you. At the end of the day, I think we're doing okay there. We're not doing horribly. This was really a sideways year, especially in silver. You had two pops. You had a pop last year in both gold and silver because of the pandemic and the reaction, people going to safety in the precious metals. You saw silver go up from $10, $11 to what was it, 29 or 30? I forgot what it went to. And then this year, earlier, with the retail silver squeeze in silver at the end of January, beginning of February, all that offtake of silver from the London market through SLV, the ETF, we saw incredible demand, physical demand manifest, and we saw silver pop again. So I do think, Elijah, that the younger generations are coming to silver, especially more than they are to gold. I just got through talking with Andy Checkman at Miles Franklin. That video will be up on our channel Thursday evening. And I asked him specifically, tell me about your silver sales. He says about 90 to 95% of what he's selling this year is silver. It's silver, silver, silver. And he said the last 2 years have been the biggest years in his company's history. So what that means is the physical demand is there from the retail side. One thing that we're also seeing is a lot of offtake on the derivative market, the COMEX, of silver out of registered. My good friend and our channel moderator, Michael Sayre, looks at this and puts it out on his Twitter. You guys should go look at that. The registered inventories, or the publicly available inventories of both silver and gold, are coming down, but silver especially. It's being off-taken. Now, is it being off-taken by manufacturers like Apple and Samsung who use silver in all their products, by the EV manufacturers, the car companies, the medical manufacturers, the space industry? Potentially, but it's coming. We don't know. We don't have those transactions, but we see it coming off. So what we're seeing, Elijah, is increasing physical demand. We just had the update in November from the Silver Institute saying they expect to reach record demand in silver again in 2022. We had record demand in 2021 of over 1 billion ounces. We're going to have even more, maybe another 111 million ounces in 2022. Silver Institute called that, nailed it this year. We'll see if their prediction is right for next year. So incredible physical demand. Now, the prices don't reflect that because the derivative markets are only speculative on what they think is going to happen to gold and silver in the next 2 to 3 months. So until we have that big economic event, you're not going to see the prices really rise in terms of spot price. But understand this. The physical demand is through the roof, and it's through the roof on the industrial side for silver and on the retail investment demand side. And with the central banks continuing to buy gold, it's very robust in gold as well. The prices tend to catch up later in the derivatives markets. So I do think we're going to see strong gold and silver prices for 2022 based upon all the data we're seeing. But really what's going to drive the next leg up, and specifically gold and then silver, silver usually follows gold, is going to be that next economic event. So we're going back to what we talked about at the beginning of the presentation. What does the Fed do? How does that affect the equity markets, the housing markets, the bond markets? How those fare in the first quarter, first 4 months of 2022 is going to tell you where gold and silver are going to go for the next 6 months after that. If there's panic in any of those markets because of the Fed decision, or we have some sort of black swan, another Evergrande occur in one of the debt markets around the world, you're going to see gold pop and silver will follow. So pay attention to the economic news the first couple of months of 2022, and that's going to tell you exactly where gold and silver are going to be trading.
Definitely. And I think mentioning the physical demand that we've been seeing, as a licensed broker with Miles Franklin, I've been seeing that demand as well. And we've seen a whole lot of demand. I mean, we've actually seen a lot of supply being wiped out and premiums increasing as well. So, yeah, definitely echoing what Andy Schectman said, that physical demand is still definitely very strong right now.
Yeah, and guys should go to your channel. And I know you guys have an email and contact information for how to get silver. My conversation, not only Andy, but people who are wholesaling the 1,000-ounce bars in the market, I've made a lot of contacts the last year with that end of the market, are telling me that we're getting tighter in silver and from a physical perspective. So if you guys want your silver, go through this channel, the relationship with Miles Franklin, and get it. My conversations with Andy and the wholesalers lead me to believe we're really getting to a shortage condition. It's not going to happen in the next month or two, but you're not going to have that much longer to get your physical silver. Gold is in more supply. We have gold. Gold's okay. But silver, it's a different story, man. It gets used up industrially, and it gets put into landfills, and we don't have as much above ground available. And silver's more affordable to the common man. You see another silver squeeze, you see another big economic event, that may be it for the medium term, for the next 6 months to a year on silver availability, or maybe even more. And we don't have the mine production coming behind it that's as robust as we've had the last 10 or 20 years. So that's the other end of the supply chain that we have issues with. The next time we have a big economic event and silver sells out, we don't have those millions and millions of ounces coming to refresh the market that we had before. We have decreasing overall worldwide silver inventories, proven and probable in the ground. And we don't have the mines over the next 5 to 7 years identified to replace what we're producing right now. This is something that people need to understand. The long-term potential supply shortage conditions in silver are flashing red on the dashboard. So if you want your silver, work with Elijah, work with Miles Franklin to get it now. Because, this time next year, are we going to have $23 silver with relatively low premiums? I don't think so.
I think it's so interesting because I know last year around the beginning of the year, a lot of financial institutions were making predictions for silver around $40 and $50. We didn't see that yet. Do you think they were maybe just early on their predictions?
I think they were looking at fundamentals, Elijah, but I don't think the derivative markets follow fundamentals on it. I mean, they do, but until, like I said, we have that next economic event, which drives the next shortage, and then I think you'll see it. I think we were all ahead of the game there. We saw a silver squeeze, saw what happened last year with the pandemic and the effect on the silver price. And we're like, okay, it's ready to go. And then we also looked at economic fundamentals to say, okay, 2021 is a year. We were a little early on that call. But I do think legitimately we're getting that situation. I know people think that we're crying wolf here because we wouldn't at Goals Are Pros, and my days of writing Seeking Alpha, I've been talking about shortages upcoming the last 10 years. And they've taken that amount of time to finally get to this condition. But we are condition red. I mean it. We are condition red. The next time that we have a run on physical silver, and it could be a 3-day run like we saw in late January and February, 110 million ounces. The next 110 million ounce run, we're very low at that point with not a lot of production coming. That's when you're going to see silver pop. You'll see gold pop too, because the condition that causes people to go into silver will cause people to go in gold. But you'll have more available gold. So right now, if you're a gold and silver investor, invest in silver first, in my opinion. That's what I do. And then invest in gold after. There's more stock available of gold. That's my approach, because the supply conditions in silver are really very dire compared to gold.
I think with silver, it's a very interesting situation right now, and a very, I guess, positive investment thesis, because at the same time, you're looking at one of the most stable assets throughout history. It's always had value. It's a safe haven. So it has that safe haven status, but it also has the incredibly bullish fundamentals of the industrial use and as you mentioned, the possible shortages in the future.
Silver is the most unique asset class I've ever analyzed. I was in real estate for 18 years. I wrote about stocks for 12 years, so syndicated all across the internet. I had at one point 4 financial licenses, Series 3 for commodities and Forex, 6, 63, and 7. So I was a fully licensed broker. So I understand, the way the markets work. I've never seen an opportunity like silver ever in my lifetime. It is the most unique investment proposition I've ever seen, which caused me to go focus on gold and silver a couple of years ago when I started Gold Silver Pros. I looked at this and said, this is ridiculous. I honestly think in my opinion, if you're looking for the next big investment, with all due respect to the cryptos, it's not cryptos, it's going to be silver. Silver's the next big one. And I don't think we have that long to wait. I honestly don't. Maybe a year, maybe 2 before this all plays out, in the big bull market that we want to see in gold and silver, specifically silver. But I don't think we have that much time left, relatively speaking. And what we need to do is especially teach the younger generations this. I think my generation, Gen X and the baby boomers, kind of know, because we kind of remember gold and silver in our money, and we remember the Constitution. The younger guys may not know this. They live in a world of now crypto and fiat dollars since 1971. So we really need to get the word out to them. They're the ones that are probably the most underrepresented in precious metals ownership, but they're the ones that stand to lose the most because they're in their prime earning years now. The millennials are, 35, 40 years old now. So we really need to outreach and help them as much as possible, and that's what we're trying to do.
All right. And the website there is goldsilverpros.com. Any last thoughts you'd like to add, Robert?
I just wanted to wish everybody a very happy New Year's. Hope you guys had a wonderful year in 2021. Appreciate everything that you guys do on your channel, Elijah. The information that you guys provide is so beneficial. I've been watching your channel for years, and you guys do such a great job. You have some of the best guests. I'm proud and honored to be a part of it. I hope that we can be a part of it next year. And I just wish everybody well in the coming year. I know that we're going to go through some tough economic times, but if we pay attention to things and we help each other and, teach each other, we can get through it.
All right. And we really appreciate all the work you do in coming on the show. Never a dull interview, Robert. So thank you so much, and God bless, and have a happy New Year.
You as well.
This is Dunnigan Kaiser, founder of Liberty and Finance. I'm now a licensed gold and silver broker for Miles Franklin. Call me directly for the physical gold and silver that you need at the best price with personalized private service from one of the oldest and best companies in the business. 31 years strong, A+ rated by the Better Business Bureau, 0 complaints, licensed and bonded. For physical delivery, vault storage, or precious metals IRAs, excellent prices, privacy, and confidentiality. Pay by check, money order, ACH, bank wire, or Bitcoin. Satisfaction guaranteed. For fastest service, just call 1-888-81-LIBERTY. That's 888-81-LIBERTY. And either I or one of my sons and fellow brokers will call you back as soon as we can and understand your needs.